in California, and they're now sold out.
It was interesting. It's the first time that we've seen that. It makes it seem more like a home.
The guy there, he's an actor named Jason Simmons playing the dad in the house. He was Logan Fowler on Baywatch. It was hilarious. One person coming through even recognized him. She kind of freaked out. Nice guy. Anyhow, I digress. Will these incentives last? Butch Boykin in Virginia thinks they're going to be around for a while. Too many buyers are sitting on the fence waiting for a bottom. Down in Florida, Ken Coulter, more optimistic Bill. He thinks they're going to be a short-term solution to work through the inventory. He's talking months, not years. Back to you.
Only in Southern California you run into an actor. Yeah. Thank you, Jane Wells. Now, Wall Street is well aware of the hurt for most home builders. Check this out. Year to date, the S&P 500 is flat. The housing stocks have dropped more than 30%. But you have to keep things in perspective. Over the past 5 years, the S&P Home Builders Index is still up more than 130%. So is there still more selling to come? With us tonight, some bulls and bears. We got Margaret Whelan. She's a home builder sector analyst at UBS. She is a home builder stock bull. Bob Wahlberg, columnist for CNBC.com on MSN, is a bear on the home builders. And Doug Cass is president of Seabreeze Partners Management. Now, generally, he's a bear on real estate, but he's been selective with his investments. He likes some of the home builders, but he doesn't like real estate investment trusts. I've pretty much told your whole philosophy on real estate right now. I've got to go. Good to see you. Margaret, why are you a bull on home builders, even at this point?
We're a bull on the stocks for a lot of reasons. First of all, they're so cheap on a valuation basis. Typically, stocks that are perceived to be cyclical, when they're looking at trough earnings, will be trading at peak multiples.
Were you a bull even as...
We've been bullish for years,
okay,
for about 7 years.
Down, you remain bullish. Why?
Because the stocks came down before the valuations, and also we're looking at a lot of the economic variables like rents growing up so quickly. That's what's driving inflation. We're looking at the home ownership rate being so high. We're looking at the fact that the jobs economy, the job growth is still pretty positive.
So you just like the fundamentals for these home builders. They're still
fundamentals are great, and the stocks are cheap.
Bob, why are you a bear on these home builders?
Well, one, obviously the momentum has just been awful. As you said, the stocks are down about 37% on average year to date. And then if we address the valuation question, to say that they're cheaply valued now is largely based on analyst estimates for future earnings. And I think those estimates are still way too optimistic about what's going to be happening for those stocks. We have a perceived 3% decline this year in earnings, and then an average of 14% decline next year for earnings. And we've seen just in the last couple of months, or last couple of weeks, a couple of firms downgrading estimates much higher than that. So I think it's going to be a lot uglier than people think.
Mr. Cash, you break the tie for us here.
Well, it's easier to be negative on the housing sector, which I am. It's harder to make a call on the housing stocks. I disagree. There's no one that talks their book like real estate people, I've learned. Maybe hedge fund managers. But history teaches us a lesson, both in the valuation of the housing stocks and in the cycle. In the last 3 down cycles, major down cycles, in the 70s, 80s, and 90s, there's been a 50% on average unit decline in new home sales and a 26 to 56 month decline in activity.
Okay.
We're only 7 months into the decline, which statistically started in October of 2005.
You still feel some home building stocks have come down enough that they're compelling to buy right now?
In the real estate boom in the last town hall meeting, everyone was optimistic. Earnings guidance was going up on a weekly basis almost, and insiders were bailing out of their stocks. And the stocks were at 2 times book. Today, they're back at 1 times book.
Which are the stocks that you like right now that have come down enough?
Well, I think the smartest man in the room is Bob Toll, who started to buy back his own stock personally.
Like Toll Brothers?
Yeah.
What do you like?
I like Toll. I also like KB Home. I think they're the best operators, and they go after the single-family market, which is important.
Which ones do you like the least? Or hate the most, or however, how do I characterize that?
I'd probably paint them all with the same brush right now. If I'm an investor, I'm not looking to buy any of these here. I think, as Doug just mentioned, we've only come down now for a few months in these stocks after a 5-year rally. You're going to see recovery rallies that could go 5 to 10% or so in the stocks, but you want to sell into those. I still think you're looking at 25 to 30% downside across the board.
Those of you representing Wall Street tonight, thank you very much for joining us. Time to take a quick break here. When we come back, get ready for the guru of personal finance herself. Susie Orman's in the house. She'll be here to take your questions. Plus,
3 acres, 8,000 square feet, 7 bedrooms, world-class strolling gardens, and a lake-sized pool. All this for the low, low price of $16 million. Really? You won't believe how much they've cut the price, though, and it's still sitting there. We'll be right back.
Your CNBC Survival Guide. Real estate. What now? Continues. Here again, Bill Griffith.
Welcome back, and we are very happy to be joined by our own Susie Orman, expert commentator on personal finance, award-winning host of the Susie Orman Show. You just won a Gracie Award. Congratulations for that.
That's something?
Yes, it is.
Yes, it is.
So anyway,
yes, sir.
People want to know, when you get ready to sell a house, you want to add value to that house, the prevailing wisdom is you fix up the bathroom, you fix up the kitchen, or whatever. Good idea?
Used to be a good idea, in my opinion. I have to tell you, I'm kind of changing my mind here.
Really?
Because there are so many contractors out there in demand right now. People are fixing up things and they're paying a fortune for it. And here's the problem. You sell it, the buyer doesn't like what you've done, maybe you turn them off, and they don't think they're getting a deal. So here's what I'm telling people right now. Don't fix it up. Let people think they're getting a deal. Let people think that you didn't buy this so that you could flip it and make money on them. Let them buy it thinking, oh, if I fix it up, I can make more money. So I would not be fixing up my home.
Is that because it's a down?
Right now.
Is that because you consider it a down market right now?
Oh boy, I consider this a down market. That's putting it mildly.
I thought you might. Stand up, sir. What's your name?
Brian Kuehl.
What's your question?
We're presently buying a home, and we're going for a 30-year fixed-rate mortgage.
Good.
I priced out mortgage rates with brokers, and I also went to a banker that I have a business relationship with. The brokers are about 1/4% less than the banker, but the banker's really holding my hand. She really actually seems to care about all my million questions that I have and answers them even after hours.
What's the question?
Is the price of me going with the banker worth the loss of that 1/4%?
Everything else is identical. Closing costs, terms,
Yes,
everything is
everything,
identical.
no points.
Are you out of your mind?
Yeah.
1/4%.
What do you really think, though?
No, but 1/4% less is a lot of money on a long mortgage, number one. Number two, chances are once you've gotten this mortgage, you never talk to your mortgage broker again or your banker about your mortgage. You just pay your mortgage. It may even be that that banker gets fed up with that bank and he's gone. So now you're paying 1/4% more for 15, 20, 30 years. Don't you dare go with a more expensive one just because you're more comfortable. Not on my watch.
Okay.
Right.
You got it?
Got that? Okay.
Yes, ma'am.
Yes.
What's your name?
Carrie.
What's your question?
I would like to ask Susie, I'm selling 2 homes and I'm purchasing a home. How much should I mortgage?
How old are you?
45.
Oh my God, like that's heavy duty. I'm 55, I look good, don't I?
Yes, ma'am.
All right,
you
yes,
do.
right, anyway, all right. Here's the bottom line for you. Are you going to be staying in this home?
Yes.
You are, all right. Do you have enough money to buy this home outright?
Yes.
Do you have enough money to buy this home outright and do other things besides? Because there's even more money than that. Would it make you feel secure if you own this home out totally 100%?
No.
It wouldn't. All right, then you're going to have to decide how much you feel comfortable putting down and taking out a mortgage. At the age of 45, I have to tell you, I would not be caring about the tax write-offs right now. At 6 3/4% interest for a fixed rate right around there, I would be taking my money, I would be buying it outright. I would then know I own this home. I would then take the mortgage payment that I would have been making.
Yes.
I would be taking that every month and dollar cost averaging that into the stock market, saving it or doing something else, because if God forbid something happens to you, you better make sure that you haven't done something else with that money, because how are you going to pay that mortgage? At 45, I'd be paid it off.
There you
That's
go.
what I tell
Thanks,
you.
Grace. Speaking of which, what about PMI? What about mortgage insurance? Do you like that or not?
You know, I hate PMI. Listen, everybody, you have to pay PMI when you put less than 20% down. PMI stands for private mortgage insurance. It is usually $45 per month for every $100,000 of a mortgage that you take out. How do you get around it if you're only putting 5 or 10% down? Oh, your mortgage brokers tell you, do a piggyback loan. That means you put down 10%, let's say. You take out one loan for 80%. Maybe it's fixed. And you piggyback on top of that a home equity line of credit for 10%, and then you don't have to pay PMI. Don't do it. Don't do it. Home equity lines of credit, the interest rates are skyrocketing. You're going to be at 9, 10, 11% before you know it. You want to avoid PMI. As long as you have more than a 90% loan to value, you can buy your PMI up front. 1%